First presenter this morning is Peter Schultz. Now, Peter has been showing self-directed investors how to trade successfully since 1996. He is nationally known speaker on options trader. He's the founder of Cashflow Heaven with the primary goal of helping individual investors achieve a better lifestyle through trading strategies proven to produce exceptional monthly returns. Now, in his presentation today, he's going to be talking about selling credit spreads in volatile markets. He's going to share with us why selling credit spreads is a smart, high odds strategy for today, the 3 strategy rules for consistent leveraging time decay, and when to close your position to protect your profits. And with that, I'd like to welcome Peter to the room. Peter, good morning. How are you doing, buddy?
I'm doing fantastic. I wanted to, normally I just show my screen, but I just want to say hi to everybody. I think Zoom's really cool. It gives us a chance to all actually see each other and get to know each other. And Pat, it is so good to see you. And listen, with all due respect, I don't know how you stay so good looking, and you're like you're like a similar age to me. So one of these days you're gonna have to like slip me the secret, As long as I don't have to make any deals with the devil, I'm okay. But other than that, I'm if we got to take a trip to Switzerland, I'm all about it. And Raleigh, of course, you're a very handsome man.
Oh,
just not to leave anybody out here. But anyway, I'm really excited to do a little presentation today. Just wanted to say hi, introduce myself. You can see my meticulously kept office here. So I just want you to know, if you're not a super organized person, or if you don't get all the details perfect, you can still make a lot of money in the markets.
And use the screen. Cover
we have no idea what's behind that.
He's in the garage.
So listen, I know we have a really limited amount of time, and I know we have a bunch of great people coming up, and I've got a ton of good information to share. So I'm going to just pop onto my screen. And listen, I want to let you know that if you're listening to this presentation and you have a question, I really want to answer it. Give me your best questions, all the doubting Thomases or anybody, just tell me what you're thinking. But if you could just write it down real quick, I'll do my best to go through the presentation pretty quickly and pretty clearly. And then at the end, I can answer any questions you might have. So, and this is a crazy market right now, pretty volatile. Just took a glance at the S&P, it's way down today. So this is a really good day. You don't want to talk about raincoats on sunny days. And we got kind of a rainy day today. So it's a really good time to talk about what we're going to talk about. So
well, that's great. Well, Peter, I will share this. You take the time that you need. We got a little bit late start, and I don't want to compress what you have to say. So you take the time that you need. We're really looking forward to your presentation. Take it away, my man.
All righty. Thank you, Raleigh. I appreciate it. Okay. And I'm going to get to slideshow. Okay. Raleigh, can you just tell me, can you see my full screen? Because I'm totally in full screen mode right now.
Not yet. You need to go ahead and share the screen at your end. Click the perfect.
Okay, so thank you, Raleigh. I'm going to just get rolling. So also there's going to be certain times you're going to want to take a little note. The notes are important. I won't overload you with too much, but there's certain things about this you're going to want to remember. So here we see a bunch of people on a roller coaster, and they are all having fun. But the problem with the markets is, sometimes it's not fun when things get crazy. And when people say volatility, that's, I think that used to be a euphemism for the market going down. Right now, it's the market jumping all over the place. So you can get whipsawed out of trades pretty darn quick. And Raleigh did a good job of introducing me, but my name is Peter Schultz. I'm the founder of cashflowheaven.com and thewinningsecret.com. We're going to mostly talk about the winning secret, but I've got some other really great, really innovative strategies, particularly for playing high volatility events. So if you've always wondered how you can trade options successfully when you know there's going to be an explosion, but you don't really know which way, I've got some really great strategies for doing that after a lot of experimentation and a lot of thinking. So what we're going to talk about today is selling credit spreads. And it's interesting because if you're an options trader, you've ever dabbled with options, chances are really good you've bought, straight calls when you think a stock is going up and straight puts when you think a stock is going down. And those can be great strategies. That's where most people start out because it's pretty simple and the potential of making a lot of money is there. What a lot of people don't consider until you've lost a few times is your probability of winning. So, a few years back, quite a few years back, about 10 years ago now, I really switched about 90% of my trading to selling strategies and selling credit spreads. Now, what's interesting is that when I started listening to folks that have been around options a long time, so we're talking about the real pros, so the market makers, the people that have been down in the options pits, the John Nigerian types, the Tom Sosnoff, who started Thinkorswim. These guys, they came to this conclusion on their own, just like I did, is if you want to make money in the options markets, you will concentrate on selling options. And there's a bunch of really great reasons for that. So most people, when they get exposed to credit spreads, and I'll show you what they are real quick if you don't know, but they say, oh, that's kind of a boring strategy. That's a strategy where you have to hang out and, wait too long or whatever. And they especially don't like them when it comes to volatile markets. So most people will tell you that selling credit spreads in volatile markets is crazy. It's not possible to win because credit spreads are typically thought of as a low volatility strategy. But what you're going to see in this presentation is it's not only possible, but it's better than any other method of trading, including buying stocks, shorting stocks, buying options. And you're going to see why in this presentation. But I'll just give you a big hint right now. I'm going to give you some specifics, but the big clue here is that credit spreads or selling options, selling strategies are so darn forgiving. So the problem with buying a straight put or a call is your timing has to be perfect. So even if the chart says, this thing is going up, if your messenger sort of dawdles a little bit on the way to making the big deposit in your bank account, looks in a few storefront windows, stops for an ice cream cone. If the stock doesn't do what you think it's going to do in this very limited amount of time you set, you will lose money. And time decay is working every day. So if you've been pretty frustrated with your options trading or even just a little bit frustrated, I think this presentation is going to be just a huge eye-opener for you. So let's get into the specifics. The key to stacking the probabilities overwhelming in your favor. So I'm going to repeat that. The key is stacking the probabilities overwhelmingly in your favor. Now, the really cool thing about options is they're based on a mathematical formula. If that's the case, we can take a look at those probabilities and just stack them so far in your favor. What I love about this is you don't have to be so good because the strategy is good. So what I tell people is kind of a graphic illustration is you can put on a trade, go take a shower, slip on a bar of soap in the shower, fall on your head, go into a coma, and wake up 10 days later, and you have over an 80% probability, over an 80% odds of winning on that trade. So what I love about that is you're going to hear a lot of good speakers. There's a lot of good speakers yesterday, but in many, many cases, you have to be just so sharp. You have to be Johnny on the spot. You have to recognize this pattern. You have to get in at the right time, get out at the right time, and that's great. If that's the guy that you want to be, still do that. But even in that circumstance, I'd suggest that you do that with 10% of your money and do this with 90%. Because this is so forgiving. And when things don't go right, when things do screw up, like they always will in the market at one point or another, I'm going to show you some really great safeguards to make sure you don't lose too much. So there's 3 big stackers you'll need to win consistently and generously, and we're going to hit those right now. So your first key deck stacker, number 1, is sell where the stock is not likely to go. So this may seem really obvious. So really quickly, I'm going to show you what a credit spread is. And with some of this stuff, I kind of assume but not everybody does. So let's just say we're talking about this first arrow here, and we've got a stock that's sort of rising. It's got a nice trend line going up. So what we're going to do is we're going to take a support level, and we're going to sell a spread underneath that. And here's what that means. We're going to sell puts at this price level. You always have a finish line with options. That's the great part about them. This is expiration. And then to hedge ourselves to make sure we can never lose too much money, we're going to buy an option here. So we're going to buy puts and we're going to sell. We're going to sell a put closer to the money. We're going to buy a put to hedge. The only amount that you are liable for or that you could possibly lose is this amount right between the two strikes. So in a lot of cases, we'll do on the SPX, we'll do a $5 spread. Most options now, it's really cool. They've got weekly options on anything with a lot of liquidity. And we do $2.50 spreads. So in this case, let's say this is a $2.50 spread. Now, a typical amount of credit that we're going to collect, this option is worth more, the one that you're selling, than the one that you're buying. So it creates a credit in your account. And a typical credit for us to collect, what we're kind of shooting for, is 50 cents. Now, sometimes we'll do better, sometimes we'll do a little less. But once you collect this money here, it is yours to keep no matter what happens. That is your money. That's what you got for taking this risk. So if 50 cents doesn't excite you, just keep moving the decimal point till it does. So if you'd like to make $500 per trade, you can certainly do that. If you've got a pretty big account and you can diversify, maybe that's 5,000 a trade. Maybe to start off with, when you're first learning the strategy, and I suggest people just really ease in, paper trade at first to see how the markets work and see how the strategy works, and then do just one contract. One contract in this case will equal a $50 bill, which in some jurisdictions will still get you and your sweetie a nice dinner. And once again, you can certainly up that with more contracts. So what happens here, if you want to take a look at your risk, is if you collect this 50 cents, then the only amount of money that you have at risk, the only amount that you could possibly lose is $2. And so if you divide the amount of money that you can make into the money that you could lose, that comes to a 25% return. Now, if you like to buy options and you go, well, Peter, I like 50% returns and 100% returns, and I'm a big speculator. I think that's fantastic. Just take a look, take a hard look at your probability of winning. And what you'll find is it's kind of the reverse of what we do. So you might have a 20% probability of winning while somebody that's selling you that option has an 80% probability of winning. If you have an 80% probability of winning 25% in 9 or 10 days, that's an incredible rate of return. And I'm going to show you what this can turn into, even if we cut our expectations like down to the bone. So this is kind of the basic anatomy of a spread. And here's what I just want to say, just one little trick that you can kind of take to the bank here. I'm not going to spend a lot of time on it, but this is part of our strategy. Let's just say, everything's going great. The trend is totally on your side. The market's cooperating. The wind's at your back. Everything looks good. And the market does something that markets are famous for doing, particularly right now. And it reverses trend. And it just, the minute you put on the trade, it goes right on down. This is just your luck. And it goes right on down and it hits your sold spread. What I show you how to do in my training package is how to set an automatic order to close the spread completely. Just get rid of it. The instant your sold strike is touched. Now, here's what I want you to take away from this because it's super, super important. Before, we could lose a potential $2 on this trade. But if we set a stop right here, the options formula tells us, and this is actually pretty accurate, that you can only lose half of the distance between the strikes. So this really cuts down your risk. So instead of losing this whole 250, you can only lose, theoretically, sometimes it's less than this, for closer to expiration and a lot of time value's gone out. But instead of losing a possible $2.50, you can only lose a potential $1.25. And then, like I said, you're going to get to keep that credit no matter what. So now your potential loss is only $1.75, we've really cut that in half. So all of a sudden your losses are not nearly as scary. They're automatic, so you don't have to watch your trades. This is a super great way to trade from a lifestyle standpoint. You just don't have to hover over your computer unless you want to. So that's just a really quick primer on credit spreads and what you can make. I'm going to show you what your, some real potential is in the real world. But I just wanted you to have that just in case you're not real clear on what credit spreads are. They're a fantastic way to trade, and I'm going to show you why. So, so here's why it's a lot easier. The whole thing here is it's a lot easier to determine where the stock isn't going to go than where it will go. And when you buy options, you have to not only determine where it will go, but your timing has to be perfect. So this is a trade we just recently did. In fact, it's not expiring until tomorrow. We get paid. We try and get paid multiple times every Friday. Those are our paydays, and Fridays are pretty exciting for us. So this looks like a great breakout. So a couple of weeks ago, the market started getting jiggy and the trend started breaking. The S&P 500 and the other big indices started breaking down, and things got a little scary. So that's when we got a great big message. The market was telling us, hey, switch out of the speculative sectors like tech stocks, which are getting hit really hard. And you probably know this already, but the reason for the sell-off right now is higher interest rates. Everybody's scared of higher interest rates. Everybody's scared of the bond market pulling money out of the stock market. There's a couple of sectors that are really susceptible to higher interest rates. One of them is the tech sector. Another one is small caps. And so those are previously high flying sectors. They probably will be again, but right now they're getting pretty hit really, really hard. So what happens is money rotates or it shifts into safer sectors. So this is one of them. This is Anthem Healthcare. And healthcare stocks are, great defensive stocks. And so what happened when the market started breaking down, so as you can see, this is back on about 222, 223, is the stock broke out of a long-standing resistance point. So if you're a breakout trader or a swing trader, you'd say, oh yeah, man, this is great. This is the trigger traders look for, this breakout, to buy the stock, or in some cases buy calls. And you can certainly do that, but I'm going to make a really good case for selling a put spread instead. And so what we did is we sold this 295, we bought the 292.50 to hedge, and we collected on this one 60 cents. So we collected more than our 50. This turns out to be an even better return. But the point that I'm trying to make is the stock is breaking out, it's going higher. So we're going to sell actually below support. This is a super safe trade unless things really break down. If you take a look at Anthem this morning, and the ticker on it is ANTM, the thing just had a huge breakout to the upside. I'm talking about, it could go to 310. It's already exceeded that. The stock just went like this. So, this is great. This is a great trade. This is exactly what you're looking for. But the point is don't try and second guess things. Sell where you think the stock isn't going to go, and that's a lot easier. Now, keep something in mind. We didn't need this big extended breakout. This thing could have bobbled around. Heck, it could have even broke support and bobbled around a little more. All that has to happen for us to win is for it just to not touch our sold strike. As long as that happens, you're going to make your full profit on this trade. It is so darn forgiving. And I'll tell you, when I first started trading, I thought, well, this is going to be a piece of cake for me because heck, I'm so darn smart and I'm so darn quick and I'm so good at everything I do. And I get in there, and I don't know if you've noticed about the markets, but there is no more humbling experience than trading in the stock market. I think it's even more humbling than that junior high school dance where you'd make that pilgrimage all the way across the floor to ask that girl to dance, and then she'd tell you no, and then you had to walk all the way back to the jeering, derisive guffaws of your friends. Okay, so the stock market is even more humiliating than that. And so very quickly I found out I wasn't the smartest guy in the room. I wasn't the quickest guy in the room. It actually it isn't quite as quick as I would have liked. That took a few years, and it took thousands and thousands of dollars in losses. And I finally figured out I need a really forgiving strategy that just kind of wins with or without me most of the time. So the part of this that you will have a hand in is, picking your stocks and picking where you're going to put your strike prices. but I'm actually here to help you with that, and got a lot of experience, and I can show you some really good methods. But it's so forgiving. You're just going to naturally win most of the time. And I think that's what most of us need. So instead of being afraid of volatility, it can be quite an opportunity. So the trick is to watch the pattern and sell against it. So this is DraftKings. They've gotten a lot of publicity over the last few years, and they're really doing great. The revenues have just shot higher. So one of the classic patterns that we look for in technical analysis is this rising wedge. Rising wedges are a great pattern. You almost always see a breakout before it gets down to this little point here. So we saw this breakout. So this is your trigger. Now, once again, this would be a great trigger for somebody to buy the stock or buy calls on it, but that's not what we do. I've just learned to be cautious. And if you want to like make money and hang on to the money you have, it's just a great idea to switch to a strategy where you just win most of the time. So look what happened. The stock went straight up. That's really cool. That's great. That's what you want. But say you had calls, all of a sudden the market, even though DraftKings is still doing well, the market decides to sell off, and boom, what happens to the value of your calls? And now look at this. They're actually below where you bought in, and all the times run out. You'd probably lose money on this trade. We made money. We made really good money. We made 29% in just 9 days of trading. And the cool thing about this is there isn't a lot of sweat going on here. I mean, we just put this thing on. We enter our automatic stop right down here at our sold strike, and you can go take a nap. I mean, take a picnic, go to the gym, fly off to France to see if the baguettes in their bakeries are better than the ones in your hometown. Enjoy your life. That just keep in mind, from kind of a philosophical standpoint, you're trading to improve your life, not make it so you're handcuffed to your computer worrying about every single uptick and downtick of the market. So if you want a great lifestyle and make some really good money, this is a great strategy. Okay, one of the reasons we're sellers is one big trick to making money this way and increasing your probability is to sell on the perfect point of the time decay curve. So every single day puts money in your pocket. And what I've determined after a lot of experimentation. So you see out here at 4 months, your time decay is fairly flat, steepens up a little bit from 3 months to 2 months, steepens up a little bit more, and it actually starts to accelerate downward when it looks like you're going in that last week between being the second month out and what they call the front month. And then here's what happens in the front month. The final 30 days is you get this really steep time decay. So what we've determined as the perfect point to sell is there's a sweet spot right in here. Now you want to sell enough time to still collect some really good premium, but you don't want to sell too much time because you want this real steepness here. So that's about, just as a rule of thumb, what we typically sell is 9 days of time. Now it looks like 10 days when I come out with my recommendations, but I come out with them at night after the market's closed. So by the next morning, you really have 9 calendar days until expiration. Take out 2 days for the weekend. You've actually only got 7 trading days. And you know what happens with 7 trading days? You have a lot of time decay. Every single day actually puts money in your pocket. But if you lay around at night like I do, and you think about ways to improve your odds and your situation, and you think about all the different aspects of options, there's a really, really cool way to actually improve your odds and accelerate time decay. So once you collect your money here, by selling your spread, you want to get as close and as quickly to the finish line as you possibly can, because that's when all your risk goes away and you actually get to heave a big sigh of relief and realize that credit has taken up permanent residency in your account. So here's what I want to talk about right now, and this is one of the coolest things you'll ever learn about options. How can we accelerate that time decay? So that brings us to deck stacker number 2. Sell high volatility options to capture inflated premium that is likely to dissipate quickly. Remember, we make money by selling time that devalues as the option approaches expiration. Excuse me, but this strategy accelerates time decay with volatility collapse, making you money in some cases, even if the underlying goes against you. This is an incredible secret. And what we're doing, we're combining here the two most powerful aspects of options. And if you get these two great big henchmen working for you, you turn the scariest aspects of options into your best friends. These guys are going to back you up on every trade, and they're going to make you a ton of money. And here's what they are. This is a good time to take notes. It's time decay. So every day, if nothing else happens with that option or that stock, every single day puts money in your pocket. Number two, volatility collapse. So this is no more than selling high volatility, which is super appropriate for the market that we're talking about right now, and why this strategy works so good in high probability markets. So we sell high time decay, and we watch the volatility, or excuse me, we sell high volatility and watch that volatility collapse, put money in our pockets. So everybody says, aren't high volatility markets a little bit dangerous, or isn't there risk there? And yes, there is risk, but if you know how options are priced, you can take advantage of that volatility premium to make even bigger profits with less risk. Here's why. When you sell a credit spread, you're selling options that are entirely time value. There is no intrinsic value because the option is out of the money. So the key is how the market assigns value to the time portion of the option. That value has a lot to do with expectations, and expectations have a lot to do with what happened with the underlying in the recent past. For example, if a stock or index just made a big move or just reported earnings, excuse me, just whipsawed in both directions, exactly the kind of thing that happens in volatile markets, the implied volatility goes through the roof. So here's a really good example. So what we had is just a huge bout of volatility right here. This is the kind of thing that really makes options expensive. Then it bounced here, crashed here again, and those market makers put a huge amount of volatility. But here's the thing, the trend of this stock was still to the upside. So we collected 45 cents, or just 22% for just 3 days of time. So our holding period was super short until expiration, till the finish line right here. We didn't have to hold very long. And yeah, we did get a dip down here, but it popped right back up because of that overall trend. And we had a high profit, the highest profit expiration, which is where we just keep our entire premium. Super effective. So to capture that volatility, we're going to sell after an explosive move. See, this is another note that you want to take, and this is something a lot of people don't realize, is one of the best times to sell an option or sell the spread is right after earnings, right after the stock has gone crazy. So the premiums are much higher than normal, and they dissipate quickly the moment the stock starts to settle down. But here's what's interesting. Crazy wild swings don't last. They're typically followed by periods of calm. So here's a shot of the VIX. You can see these really steep periods of panic here, and then it settles down to trade in a fairly low range. So that creates opportunity, because the time value of an option can become very expensive because the stock just jumped this way or that. And often that value stays with the option even as the stock starts to calm down, which is one of the best times to sell an option spread is the day after a stock announces earnings, because the options premium is often elevated, and yet the stock is already settling down. But the real beauty of this strategy is it's so forgiving. Here's one where we did almost everything wrong and still made money. So I'm going to show you a trade that got a lot of press recently. Everybody was talking about it. It really roiled the markets. It came close to ruining Robinhood, and it's still in the headlines today. So this is Gamestop. It's the most volatile situation we've seen in the last year. Here the stock goes from right around this price level right here is right around $18 a share. Probably shouldn't have even been trading that high based on its fundamentals. And it ended up, as you can see on the chart, up here at $483 a share. Now, this is one where we did almost everything wrong. And the reason I'm showing you this is for two reasons: to show how effective and profitable trading high volatility can be with this strategy, but also how darn forgiving it is. So this is my actual write-up. This is actually what I wrote. That's a crazy move for a stock with negative fundamentals. Now, keep in mind, when we placed this trade was right here on this candle on this day. So these are daily candles. And what I saw when I looked at the chart is that the stock had gone all the way up to about $160 a share that day. And then it closed down here under 100. So I thought, that's it. This run is over. This, volatility is spiking. This is a great time to sell an out of the money credit spread. We're going to collect a lot of money. And my vision, and if you could see this on a chart where, this was the only candle, the stock had just gone straight up. It'd gone from $18 in literally like 3 days to 160. And now it was collapsing. So I said, hey, this is a speculative trade, but we're going to rush in here. We're going to collect some premium. So what we did, as you can see right here, is we sold the 100 calls and we bought the 105 calls to hedge. And we collected more than half of the credit. I mean, the premiums were just gigantic on this thing. So one of the things that I told everybody is we're not going to set a stop on this one, because what we're counting on is in the 2 weeks that we own this thing, that it's going to collapse right back down to where it started and we're going to make our money. Well, look how wrong I was. And the stock the very next day shot up to 150. The next day from that, it shot up over 350, went down a little bit, hit its high of 483. And then it started collapsing. Remember, everybody came in. Robinhood started putting curbs on the stock. They said, and I tried to do more. I tried to sell more credit spreads up here, and I got a big notice on my account that said you can't do complex options positions on this. They really shut it down. Finally, they went to the point where they said, all you can do is sell this thing. You can't even buy it. And I don't know what they were scared of, but somebody was really scared of losing a lot of money, and they just put the curbs on this thing. And even if they wouldn't, though, it would have settled down, because that's what it always does. And settled down is an understatement. This thing dropped like a rock. It dropped below our sold strikes, and at expiration, we just held on. And for people that go, well, can't they put the stock to you? You know what? On this one, nobody could do anything. And as long as your options still have a lot of time value, and of course, these had a ton because of the volatility, nobody's going to exercise. Nobody's going to give up the value of that option and put it to you early. They're just going to sell their option and collect all that volatility premium. So that's not really a big worry. So we knew we could hang on till expiration. You can see 2 days before expiration, it dropped from above 100 down to about 50. Tried to make a little comeback the next day, got squashed down again, ended up closing about 50 points under our sold spread. We made 56% in 9 days. This is an awesome return for a credit spread. And we did that even with the options halted. So I'm just showing you how forgiving this strategy is. Everybody else was trying to buy calls and puts, and then they halted options trading. It was just a real nightmare. But we're so passive. Once we had this position on, they couldn't do anything, just expired worthless, and we kept all the money. So one really easy way to see these variations in volatility is with Bollinger Bands. And basically, and you may already know this, but it's really cool, when Bollinger Bands narrow, it means that the stock is kind of calm. This is and when it's at the high point, there's big call premium, and you can see at these peaks here, those are the times to sell. And then invariably the stock calms down. Like you have a big move here. Here's a good example. It crashes and there's huge put premium. So you sell an option underneath once the thing starts to stabilize. And you can see where the bottom is. You sell your put premium, collect all of that, wait for this thing to skyrocket back up again. You see it stabilize. You collect your call premium, and then, it reverses down. You can do this all day long. I have a ton of people that are getting big Friday paydays pretty much every Friday. They're either making their living with this or they're hugely supplementing their existing income. This is a really dependable, kind of a hands-off way to trade. So wouldn't it be nice to see at a glance whether options premiums are expensive or cheap? And fortunately, there is a way. So many options trading programs and brokers now show statistics for historical versus implied volatility. Historical volatility is what the range of movement has been over a longer period of time. Implied volatility is what the volatility is doing right now. So where do we find that information? And I'm running a little behind. We started a little bit late, so I'm going to kind of speed up to get everything. And I also want to answer some questions. So I'm going to start peeling through this stuff. So make some notes. You go to the Thinkorswim platform and you scroll down to the bottom and you'll see a drop-down arrow that says today's option statistics. Click that drop-down arrow and you'll see all kinds of options numbers. But what you're looking for is the current historic volatility, HV, percent versus the implied volatility. And it's very simple. This is one for your notes. This is on the Thinkorswim platform, by the way, great platform for options trading. If implied volatility is higher than current historical volatility percentile, then the option is expensive. And we can see them circled here. Historical's at 19%, implied volatility is 30%. Probably a good thing to sell if everything lines up. You don't sell right before a high volatility event because you can really have your you-know-what handed to you. So if it all looks good, if the chart looks good, if everything else looks good, this is a really good metric to look for, to know if you're selling high or selling low. So here's what's interesting about the time value of an option. Everyone thinks the value is based on the time remaining until expiration, but it's really based on the implied volatility of the underlying. That's what makes time value cheap or expensive. It's not really the amount of time, it's the volatility. That's why this is such a huge key. So, I mean, here's a really great example. And once again, I have to kind of peel through this, but this was after Walmart's earnings. And what happened here is this is the volatility event. So right after they announced, it shot up and then it shot straight back down again. So we thought it was going to recover. So we sold the 120 calls. We sold 120 puts. We put on a put spread. But this shows how forgiving this is. So the stock exploded higher and then came back down. And then for the rest of the trade, however long we're in this thing, it looks like about, 10, 11 days here, the stock just continuously traded towards our sold strikes. Now, you would think that the value would go up as the stock traded towards your puts. But here's what we're looking at. There's two factors going on here, and this is the point of this entire presentation. We have two things going on in our favor. We have time decay. So the time value of the options is going away, but what we really have is this volatility collapse. So let's see what happened. It's a really powerful example of collapse here. The time value of the 120 puts spiked massively higher on the reversal, and you would think the value would continue to go up as the underlying trended towards the 120 strike. But what actually happened is the time value of the 120 puts dropped dramatically after the announcement and continued trending lower until it finally expired worthless. So this is the time value of the options. You can actually chart that on Thinkorswim. So here's the volatility spike. You can see how expensive those options got. This is when we sold our put spread. And then you can see the actual value of those options continued to trend down until they finally expired worthless. Here they're worth a penny right before expiration. And we collected 90 cents after earnings. I mean, that's a huge win on literally a stock that went against us and traded towards our spread for virtually the entire time. Never touched our strike, but got close. So here's actually a way bigger and better chart. You can see this is the actual value of the 120 puts. They continued to trend lower, even though the stock gradually headed towards it. So the amazing thing is the option declined in price in spite of trading towards a strike, mostly because of volatility collapse and also time decay, which in this case trumps direction. So this is our third deck stacker. This is another one you want to write down, and that is make your money and get out once you realize most of your gains, so you limit your risk. Volatility collapse lets you do that because it accelerates time decay. Here's a great example. Visa been steadily climbing. Really nice chart, right? Really nice trend. And so we sold the spread for 45 cents and bought it back 9 days later for just 5 cents, keeping 90 cents of the profit for a 20% return. And look what happened the very next day, right after we bought it back. The next day, the stock dropped right through our spread, which would have triggered a loss. This is why you take the money and run. So here's the SPX. We sold the spread for 95 cents and bought it back just 4 days later for 15 cents, keeping 84% of the profit.
And the next day the market crashed. So we sold a call spread, making a quick 25% gain on the reversal. And the point is we didn't lose any money. You can see where our spread is right here. And you can see in a million years with this trend, you would never think that your spread would be touched, especially so close to expiration. Well, it was. We've seen lots of gaps on the XPX. We've seen a lot lately. Gapped right through our spread. Boom, we would have lost money, but we got out right here. We made money. And then when the thing reversed, we sold a call spread up here and collected even more. This is a really cool, really fun strategy. So the point is once you realize most of your profits, take them. And that is especially true in volatile markets, especially true right now. The moment you close the spread, you eliminate risk, keep the profits, and free up your margin. Super cool. So the 3 keys for selling spreads in volatile markets is sell where the stock isn't likely to go, sell short time frame, high volatility options to take advantage of volatility collapse. And once you've realized most of your profits, exit the trade and lock in your gains. Follow all 3 and you stack the probabilities overwhelmingly on your side. So if you follow this strategy, what can you expect to make? The beauty of the strategy is consistent gains that compound quickly. So after factoring in cash holds, losses, buybacks, we never put our whole account in. We usually keep about 40% back for buybacks and rollovers. So what can you make? You know, we're targeting 25%. Can you expect 20%, 15%, maybe 10? So let's lower that all the way down to 5%, which is an amount I know anyone can make. And let's see what your money turns into. If you just turn it, we turn it about every 9-10 days. Let's extend that out to 2 weeks to make it even worse. Let's see what that looks like, starting with just a $10,000 account. This is your graph. After 2 years, 10,000 has grown to 104,000, and you're bringing in over $10,000 a month. Now, I know nothing like this works in the real world. Usually it's a little bit more like this, like a stock chart. But what if you even come close? And the probabilities tell us you will. Probabilities tell us you're going to win. And that's the mathematical probabilities on the options formula that actually won the Nobel Prize back in 1998 for the mathematicians that discovered it. So you can try and trade this strategy out for yourself. I encourage you to do that. And you can start with as little as $200 per trade, but there's just one problem. If you don't do well right off the bat, you might disregard the whole thing and quit. And that would be a real shame, because this really is the best way to trade, because you have a very high likelihood of winning, the hands-free nature of the trading, and the tremendous compounded returns over time. So to make sure you start off profitability and stay that way, I put together an educational package that's the best anywhere for this strategy at a fraction of the $2,500 sales price we used to charge. By the way, I still get thank you notes and emails from the people that paid that amount of money, because they made their money back a long, long time ago and are still cash flowing it every week. So I put together a package called The Winning Secret, and it includes this initial webinar, how to trade credit spreads for fun and profit. It's super fun. It's super cool. I think you're going to enjoy it. And that's what you get right off the bat. Plus you get this whole package is huge. It's great. It's really good. 161-page downloadable ebook, 10-chapter video series. I just redid that. It's great. We've got graphics. We've got really good illustrations. Everybody loves it. We've gotten really good feedback. We've got archived webinars. I keep coming up with new ways to improve the strategy, make it even better for you. And you'll have access to all new additions for life as an owner of the package. So the package, just a one-time fee. I've made it really reasonable, especially if you're an attendee of this presentation. I've got a really good special going. Plus you get videos that show you how to set up automatic orders with our favorite broker for spread trading to trap profits, whether you have time to watch the markets or not. This is the hands-free aspect. And we actually have a subscription where I come out with 2 new high probability trades late every Tuesday. So you'll probably read those Wednesday morning. I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. We've been really successful. People love it. They've stayed on with me for years. I think it's a $99 a month, but don't worry about it, because if you even do one trade, it could easily pay for the year's worth. So don't worry about that. I want the market to trade pay for your education and your subscription. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies, which is the best thing that's happened to options probably ever, but certainly since they introduced them in 2012. And this is where it gets personal. I want you to have personal instruction with, some of the best people I know. They work for us. They're right here in our office. This is Deanna. So included in this package is a free one-on-one orientation to make sure you get your account set up the right way and know how to take the best advantage of the information. Sometimes you get a new subscription and a new package, you don't really know where to start. She'll sit there on the phone with you for a half an hour, as long as you need, to show you what to click on and how to really take advantage of it. And this is the big clincher that nobody else offers. This is personal one-on-one coaching with Alicia. I live in a university town. She graduated at the top of her class in finance. She is incredibly sharp. She has made people so much money in the markets. And I'm going to throw one of these coaching sessions in with her to show you how good she is and how sharp she is. And she'll meet you wherever you're at, wherever your knowledge level is. But our most experienced traders, we've got previous brokers that continuously buy sessions with her. We've got 3-session packages and 8-session packages. People just continue. We have some people just buying back-to-back 8-session packages because they love her. They love trading with her. And she just is really good at finding incredible opportunities. She's the one I go to run new strategies by. She's sharp. She's down to earth. She's got a great bedside manner, great personality. I think you're going to absolutely love her. And you'll see why when you get a session with her. So I'm putting it all together here. If you want to get and see the really great special that I put together for you just for this event, go to westmarktrading.com/Schultz. And we're getting really close to being out of time, but I think we went over on the introduction quite a bit. So I hope they give me just a few minutes here to answer any of your questions. In the meantime, go ahead and enter the link above, and Raleigh might even be able to post it for you so you can just click on it and show you the incredible package we put together that includes everything that we've ever done and more, because we never used to include coaching. And you'll see a price that is the lowest we've ever offered, and it's never going to be seen on our website. So take advantage of attending this event and get a really good chance to make some hands-free money that I think you'll really like. So Raleigh, I'm going to leave it to you to read me the questions, and I'm happy to answer any questions people have.
Oh, that's great, Peter. What a fantastic presentation. And there were several questions that came up, and I try to clump them together. One question that came up early in the presentation was, how do you handle after hours movement against your position that you may not be able to control? For example, if the price moves past your stop point and gaps against you the next day open.
Okay, so that's a super good question. That's like the boogeyman hiding in the closet. That's like the worst possible scenario. So keep something in mind. Okay, once you buy this hedge, that's all that most people ever do, is they just hedge. So you have that, if it's a $5 spread on the SPX, the most you can lose is $5 minus your credit. We typically get a $1 on a $5 spread. So most you can lose is $4. On a 250 spread, the most you can lose is $2. So that doesn't happen too often, but in really crazy markets where, there's some super scary thing that happens overnight, it can. But once you quantify your risk and the worst case scenario, you really don't have to worry about it too much. It rarely happens, but that's a great question. If it does, that's why we buy that other option. There's services out there that preach selling puts naked. And I don't think any of those people went through the downturn starting in March of 2000 like I did. And there was one outfit that was, teaching little old ladies to sell naked puts. I know people that lost their houses. I mean, it was nasty. So I never recommend selling naked. Most of us past the age of about 30 don't look that good selling naked to start off with. So we're just going to buy a hedge, and we're going to be protected. We're going to be covered. And I think you're going to sleep a lot better at night, and you're still going to make a lot of money. So what's next?
Okay, other questions. This one's kind of interesting. Do you hang on to expiration for both positions? In other words, do you sell the position that's making money, or do you get profit automatically upon expiration?
Well, here's I usually close out the spread completely, and that's usually the best way to do it because it's the cheapest way to close it out, especially if you're going to close it out early. Otherwise, I let both of them go to expiration, but here's the one exception to that. We rarely do it because it's rarely to your advantage. But what you can do if things really get cheap and there's a few days left is buy back your sold option and leave the bought option. If the bought option is just a couple of cents, maybe just leave it there, just in case there is a huge gap or the market changes direction for those few days that's left. You could potentially make a gigantic windfall profit on an option that really only cost you maybe a couple of cents. So that's another strategy that could make this work better. I usually don't do that, but you certainly could.
Okay, a couple more questions here, Peter, as we've got a few more minutes. How do you find the stocks to trade? Do you have a favorite group or basket of trades, or do you have some kind of a scanner that you look at? How do you find those trades that you're going to place, that you're looking at?
Well, I know everybody has these super secret scanners that they have their tech geniuses program, or they do it themselves. I'm pretty low tech, and I think if you take anything from this presentation, it's that a regular guy can do really well doing this. So there's a couple things I look at. On the Thinkorswim platform, you can have watch lists. So I have 2 watch lists, and that's stocks with penny pricing. So we really like that really narrow bid-ask spread that goes in our favor. And also any stocks with weekly options. I also typically trade stocks that are expensive, maybe $150 and higher. And the reason is the spreads are really good. They're usually really liquid. I trade names that people know. The bid-ask spreads are narrower. And so what I'm really looking for is the number one thing I look for when I'm sifting through is a good chart pattern. So the same thing that you would look for if you're going long or short on any position, you want that pattern really in your favor. That's number one. And then I go and look to see if those options are expensive or cheap. I'll see what the volatility is. Usually you can see just by the chart. If it's exploded recently in the recent past, you're going to have high volatility. So those are the things that I really look for, because like we talked about, your 2 really, really huge advantages are time decay and volatility collapse. You get those 2 going in your favor, you almost can't lose. And if you get them going against you, like if you buy an option at the right time, you almost can't win. And if you've traded options any length of time, you know what I'm talking about.
Outstanding, Peter. Well, Peter, I tell you what, I wish we had more time to spend with you, because that was a fantastic presentation.
You say that to all the girls.
No, I say no. I save a few special adjectives for you, but we really do appreciate the way you've kicked off the session for us today. I mean, you're taking risk out of the trades. You're showing us how people can make money without having to sweat too much. You focused on lifestyle, which is really ultimately what we're all about here. And I just think it was a great foundation for kicking off today. And once again, thank you so much for your time, Peter. Great presentation. I hope you have an awesome day. And tomorrow is payday, so I hope you have a big week.
Thank you, Raleigh, and thank you, Pat. You guys are the best. Thanks for having me on. It's been a real fun pleasure, and thank you for watching.
You're welcome, Peter. So once again, folks, that was Peter Schultz with Cashflow Heaven. And just want to reiterate, he's got a special offer, the Complete Winning Secret Trading Program. He covered all the points there, but the highlights, he's got a comprehensive 161-page digital trading manual that comes with this program, personalized 45-minute coaching sessions, subscription to the Winning Secret weekly trading letter that he puts out, and other bonuses. So I really do recommend that you go to that special link, westmarktrading.com/Schultz, and take a good look at what he has to offer. They put together a fantastic package there. And once again, Peter, thank you so much for your time with us today.